Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about First Industrial Realty Trust Inc. Annual Report. First Industrial Realty Trust Inc. is a prominent player in the logistics industry, offering a range of services to multinational corporations and regional firms. The company's fully integrated platform enables it to provide high-quality facilities and exceptional customer service. At its core, First Industrial Realty Trust provides industrial space solutions through various means. As an owner, operator, developer, and acquirer of logistics properties, the company offers a comprehensive suite of services that cater to the needs of its clients. This includes developing new properties, acquiring existing ones, and managing a vast portfolio of industrial spaces. The company's focus on logistics properties allows it to concentrate on providing essential facilities for supply chains. With approximately 71.6 million square feet of industrial space under its management, First Industrial Realty Trust is well-positioned to meet the demands of its clients. Its services are concentrated in 15 target metropolitan statistical areas, MSAs, enabling the company to provide localized support and expertise. In summary, First Industrial Realty Trust's business operations can be categorized into several key areas. Ownership. The company owns a significant portfolio of logistics properties. Operation. It manages and maintains its own properties to ensure high-quality facilities for clients. Development. First Industrial Realty Trust develops new industrial spaces to meet growing demand. Acquisition. The company acquires existing logistics properties to expand its portfolio. Customer service. It provides industry-leading customer service to multinational corporations and regional firms. Overall, First Industrial Realty Trust's integrated platform enables it to offer a comprehensive range of services that cater to the needs of its clients in the logistics industry. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to increase. The stock price of First Industrial Realty Trust Inc. has increased slightly in the past year due to several factors. One key reason is the company's strong financial performance. As a real estate investment trust, REIT, First Industrial Realty Trust Inc. generates revenue through rental income from its industrial properties. If the company reports higher than expected earnings and revenue growth, investors may become more confident in its ability to deliver returns, leading to an increase in stock price. Another factor that could contribute to an increase in stock price is a positive outlook for the real estate market. If demand for industrial space is high due to economic growth or other factors, companies like First Industrial Realty Trust, Inc. may see increased rental income and property values, making their shares more attractive to investors. Additionally, changes in interest rates can also impact the stock price of REITs like First Industrial Realty Trust Inc. When interest rates are low, borrowing costs are lower, making it easier for companies to invest in new properties or refinance existing debt. This can lead to increased demand for REIT shares and higher stock prices. Finally, investor sentiment and market trends can also play a role in the increase of First Industrial Realty Trust Inc.'s stock price. If investors become more optimistic about the economy or real estate market, they may be more likely to invest in companies like First Industrial Realty Trust Inc., driving up its stock price. First Industrial Realty Trust Inc. maintains a market capitalization of $8 billion, broadly in line with the industry peer group. First Industrial Realty Trust Inc. trades at a higher price-to-earnings ratio of 32 times and a higher price-to-book ratio of 2.97 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 48% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 3.37%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted and influenced by various market and operational factors. Revenue growth is primarily driven by favorable industrial real estate fundamentals, including improving demand and constrained supply. Additionally, economic and business environments that support increases in distribution activity, population growth driving industrial demand, and natural barriers to entry and scarcity of land, leading to future rent growth, all contribute to revenue growth. Effective operational management strategies, such as tenant satisfaction and portfolio performance, also play a crucial role. On the other hand, revenue decline is often driven by factors outside of an organization's control, including inflationary pressures from supply chain disruptions, increased costs for construction materials and equipment, and decreased income from properties due to fixed real estate costs. Expiring leases not being renewed or relet at competitive rates, tenant bankruptcies and defaults on rent payments, and unanticipated costs and liabilities due to environmental problems also contribute to revenue decline. Effective management of property operating expenses, general and administrative expenses, and releasing costs is essential in controlling and minimizing the impact of these factors. Furthermore, strategic decisions, such as selling assets that lack strong long-term cash flow growth potential and completing development and redevelopment projects on advantageous terms, can help mitigate revenue decline. Net income and profit margins experienced fluctuations between 2023 and 2025. Initially, net income decreased by $31.9 million from 2024 to 2025, a decline of 10.8%. However, operating activities saw an increase of $108.8 million in 2025 compared to previous years. This contrasting trend suggests that while overall net income decreased, certain aspects of the company's operations improved. Profit margins also underwent changes during this period. The reclassification of an industrial property in 2025 likely contributed to a decline in profit margins. Nevertheless, NOI from same-store properties, acquired properties, and recently developed properties increased by $56.3 million in 2025. This increase was partially offset by a decrease in NOI due to the disposition of real estate worth $7.7 million. The reasons behind these changes are multifaceted. Disruptions in financial markets, volatility in capital and credit markets, and increased interest rates all had an impact on the company's performance. Additionally, property sales, acquisitions, and the transfer of development properties also influenced net income and profit margins. The increase in dividend declared per share and the issuance of limited partner units as part of the equity compensation program further contributed to these fluctuations. Overall, while net income decreased, certain aspects of the company's operations improved. Profit margins declined due to various factors, including the reclassification of an industrial property and changes in NOI from different types of properties. The company's financial performance indicates a positive trend in its operating cash flow. According to the provided information, the net cash provided by operating activities for 2025 was $461,263,000, which is an increase from $352,488,000 in 2024. This significant growth suggests that the company is efficiently managing its operations and generating sufficient cash to support its business activities. Furthermore, the funds from operations, FFO, available to common stockholders for 2025 was $391,776, which also confirms the positive operating cash flow. These figures demonstrate the company's ability to generate a substantial amount of cash from its core operations, indicating a strong financial position and potential for future growth. The company's debt level and interest expenses have undergone significant changes in recent years. According to the extracted summaries, the total debt has increased by $350,652 from December 31, 2024 to December 31, 2025, representing a growth of plus 15.8%, page 39. This increase is also reflected in other reports, with the total debt rising from $1,933.2 million in 2024 to $2,379.9 million in 2025. page 41. The company has issued new senior unsecured notes with an interest rate of 5.25%, page 82, which may have contributed to the increase in debt level. Additionally, there is evidence of refinancing of loans, which could also be a factor in the rising debt level, page 99. The impact of these changes on interest expenses is not entirely clear-cut. While some reports suggest an increase in interest expenses, others indicate a decrease or no significant change. However, it appears that interest expenses have been affected by derivative instruments used for interest rate risk management, page 97, and refinancing of loans, page 99. These factors may have contributed to the fluctuations in interest expenses. Overall, the company's debt level has increased significantly, but the impact on interest expenses is more nuanced and influenced by various factors. Management's outlook for the company is optimistic, driven by a short-term focus on increasing average net rental rates through market rent growth. In the long term, the company aims to achieve business growth through internal expansion, external acquisitions, and portfolio enhancement. This strategy involves investing in key markets with favorable fundamentals and funding liquidity requirements through selective asset dispositions, debt, and equity issuances. Management is aware of potential risks, including those related to joint ventures, ground leases, and climate-related disruptions. However, they believe the company will be able to manage these risks effectively. Financial performance has been strong in 2025, with a significant increase in cash rental rates on new and renewal commenced leases. Management expects compliance with financial covenants in 2026 and anticipates no issues. The company's capital allocation strategy involves reinvesting proceeds from sales of industrial properties into qualifying replacement properties under Section 1031 of the Code. This approach allows for tax-efficient growth while maintaining control over the form of redemption consideration. Debt obligations are managed through various interest rates and maturity dates, with management confident in the company's ability to comply with financial covenants. Overall, management is committed to driving long-term growth and value creation through a combination of internal expansion, external acquisitions, and strategic capital allocation. The company's financial reports reveal a consistent trend of dividend payments over the past few years. According to page 28, the company has indeed paid dividends, which is further confirmed by pages 86 and 63. The amount distributed to common stock and unit holders in 2022, 2023, and 2024 was $173,255, $201,065, and $243,177 respectively. The payment of dividends continued into the following years, with a total of $247,297 paid out for 2025. The dividend per share also increased over time, from $1.28 in 2023 to $1.48 in 2024. These figures demonstrate the company's commitment to returning value to its shareholders through regular dividend payments. It is worth noting that there is no evidence of the company buying back shares, indicating a focus on distributing profits to existing investors rather than reducing the number of outstanding shares. Supply chain disruptions pose significant risks. The current business environment is fraught with risks that could lead to supply chain disruptions. International trade disputes and tariffs pose a significant threat, potentially causing delays in project timelines and increasing capital expenditures, page 8. Furthermore, inflationary pressures, tariffs, or other trade-related factors may disrupt the supply chain, resulting in cost overruns due to delays in obtaining construction materials, page 9. In addition to these economic risks, natural disasters, climate-related disruptions, pandemics, war, and civil unrest also pose a threat to the supply chain, page 11. These events can cause significant disruptions, leading to delays and increased costs. The financial implications of these disruptions are already being felt. An increase in tenant accounts receivable, page 60, may be related to inventory purchases or supplier payments, indicating potential issues with cash flow management. Moreover, a decrease in investment in joint venture from 2024 to 2025, page 66, suggests that there may be concerns about supply chain disruptions. Overall, the risks of supply chain disruption are real and pose significant challenges for businesses operating in this environment. That concludes the financial summary for First Industrial Realty Trust Inc. Feel free to comment below, and I will be happy to answer them when possible.